We've obviously known for a few years now that China is very important in terms of driving global growth. They haven't been so important in their influence on global financial markets, but that is changing. We get up these days, we see what the US has done overnight, but then we watch very closely what Chinese markets during our day. So we need to watch China in terms of what injection that they're making into that financial market story more globally. Equally, I think we need to watch pretty closely the emergence, I think, of a new class of investor, the private investor in China. They run a large current account surplus. That surplus needs to be financed or flowed back into global financial markets. Up until now, the central bank, the People's Bank of China, has fulfilled that task. But increasingly, we think it'll be taken over by private investors in China. They're going to be looking at quite a wide range of geographies and asset classes to invest in, and we know they like Australia. Australia is one of those countries that has now grown for 24 years. We're into our 25th year of continuous economic growth, so we've got that good backdrop. We have positive interest rates, which is becoming something of a rarity this day around the world, and we have that exposure to Asia that global investors like more broadly. So we're an attractive investment destination, with negative interest rates in Europe and now in Japan as well. What it will do, I think, of course, it just accentuates that attractiveness of positive interest rates in those countries that have that sort of rate structure. So what you would expect to see, again, some more interest in investing in Australia from Japan. And of course, part of the policy is designed to move the Japanese yen lower. And of course, we can all have zero interest rates if we want, but we all can't have lower currencies. So if some are going down, some have to go up. So one of the risks here is perhaps these moves that we're seeing in Japan, in Europe, put some upward pressure on the Australian dollar in 2016. Yeah, we're certainly expecting to see further rate rises from the Fed. But clearly, as outlined in the Economic Political Outlook report, the sort of factors we're seeing now, that financial market volatility, some of the concerns about US growth prospects, means that rate cycle is going to be a very long, drawn-out process. Well, there's certainly plenty of wildcards, X factors, whatever you want to call them, out there in the global story. It is a US presidential election year, and that's always a time with increased uncertainty and volatility. We're going to see the UK debate whether they should remain as part of Europe or not. And as we've seen in the last couple of years, that whole idea of Greece exiting the Eurozone has had a big impact on markets. We'll get a new central bank governor when Glenn Stevens' term is up later this year. So change is the only certainty.